In this video, I will talk about net worth and how to calculate it. I will also talk about why net worth is a flawed metric for achieving financial freedom. You calculate net worth as all your valuables minus all your debts. Valuables are also called assets. For instance, stocks, bonds, real estate, cash, and primary house residences are prime examples of assets. I refer to them as assets in a loose sense because assets must have future or current economic value. As for debts, they are also referred to as liabilities. Liabilities is something that you must pay either now or in the future. Examples of liabilities include student loans, mortgages, car loans, personal loans, and credit card debt. Here are my top reasons why net worth can be a useful metric for achieving financial freedom. Net worth can tell you if you're saving enough for your retirement. People retire with a certain nest egg, and that nest egg can be measured with a net worth. The funds that you have on either your savings accounts or 401k accounts do not provide the full picture.
Suppose you are thinking of retiring with a $1 million in your brokerage account, but your student debt, mortgage, personal loans amount to $800,000. In this case, you may have to delay your retirement until the debt load becomes less excessive. Second, net worth can also show you how much money you have to spend in case of financial emergency. For instance, if you need to do a major car repair, net worth can tell you if you can afford this expenditure.
Finally, if you track your net worth, you can tell how your assets and liabilities perform. For instance, you can tell if certain credit card debt is getting out of hand. Or maybe your checking account balance was flat because you spent too much money on drinks. Net worth calculations aggregate all assets and liabilities. For this reason, it can provide not only the big picture of your personal finances, but also a line-by-line analysis. Here's a question. Does high income equate to high net worth? The answer to this question is not necessarily. The relationship between income and net worth can be summed up by the following formula. Income minus expenses is what we refer as savings. The term savings is often misused. People refer to their checking account balance as savings, while in reality savings is what you set aside in a given year after you pay all your expenses from your income.
For example, you earned $100,000 in 2023 and spent $80,000. Your savings are $20,000 and your savings rate is 20%, which is $20,000 divided by $100,000, which is a lot by American standards. In case you wonder, the average personal savings rate for the past 20 years was about 7%.
High income does not translate into net worth growth if your expenses are out of control. Moreover, savings can be negative if your expenses exceed income in a given year. This means that you either dipped into your checking account or you took on more debt. Therefore, you can view net worth as a condensed version of your lifetime savings streams. To grow your net worth, you must grow your income while keeping expenses down to generate savings. That's the only way. The net worth calculations can be either very easy or complicated depending on the situation. It all comes down to how easy or how hard it is to price or value a particular item. Here's how you would calculate your net worth.
First, add up all your assets that you possess. Here's a sample list. Next are liabilities, which could look like this. Certain assets could be hard to measure though. For instance, investments in real estate and private companies are not easy to value. Moreover, they can be illiquid. This means that they are not easy to sell and may produce smaller proceeds than anticipated.
Net worth is just a number with its own flaws. The primary reason to even calculate net worth is to determine whether you are ready to retire. If you fit into a standard retiree profile with a mortgage and 401k savings, then it may make sense. But what if you invested in a real estate and you generate rental income and have no intention to sell this real estate? Then does it make even sense to calculate net worth? Net worth just becomes a vanity number.
Also, including a house as an asset in your net worth calculations can be questionable too. Many argue that a house is not really an asset. It only saves you rent in return for paying mortgage, repairs, insurance and taxes. A primary residence house may qualify as an asset if you have a definite intention to sell it. But what if you have no intention to sell it? Then sadly it only qualifies as a liability.
What can make a primary house an asset is when you use it to rent rooms or as a place of work. Other than that, it's just a place of personal enjoyment, maintenance and repairs. It's also a lucrative source of interest and property taxes that you must pay to your bank and county.
The same thing applies to a car. While you can include it as part of your net worth, you are unlikely to sell it and consume its proceeds. A personal car is a necessity for many to get around, especially in the United States. Thus, selling your car will likely decrease your standard of living. In conclusion, including a car value as an asset can be questionable too. A car is also likely a liability for its loan payments and repairs, similar to a residence house.
To mitigate the above described problems, you can calculate first your liquid net worth. Then you can add net assets that are either illiquid or questionable if necessary. Net worth calculations are fraught with issues, but the most important question is how much net worth is enough for retirement? And this will be a topic for another video. Using net worth for determining your retirement date can be a flawed exercise. A better option is to use some sort of hybrid approach. This approach considers liquid assets, passive income and expenses in their totality. It can tell you how much liquid funds and passive income you need to cover your expenses in retirement to maintain a certain lifestyle. This will be it for this video. Please give it a like and subscribe to my channel for more videos about personal finance, investing and retirement. Thanks for watching.